July was a very, very strong month for markets worldwide, with the world index up 7%, Australian index lagging very slightly, up 6%, and the main IML fund, although a strong month, lagging the Australian index somewhat, rising 4.6%. Such a strong month follows obviously a weaker start to the year, but fundamentally nothing much could be pointed to as the cause for such strength other than really a positioning, pessimism, oversold condition at the end of June or in the middle of June. And if you look at the fundamentals, they're still pointing to quite a lot of headwinds for company earnings as you continue to see inflation rising, coming in often still above expectations. Central banks chasing hard to somehow get this inflation under control, although a narrative has emerged that inflation somehow going to miraculously slow down and central banks are almost done, which seems rather unlikely. But we are seeing companies reporting past earnings, of course, that are quite strong, but tending to be a little bit more cautious with their guidance. In the month in Australia, the IT and property sectors were the leaders, but most stocks were up overall. The stocks that didn't tend to rise were those that are reliable, steady stocks that obviously outperform on the downside, but don't do as well as when the speculative juices are flowing a bit more strongly. Things like Telstra, which despite continuing mobile price rises by the industry as the industry becomes more rational, was fairly flat for the month, for example. The banks did very well for the month, and we are underweight those. That also hurt our relative performance, but obviously a lot of stocks of ours did well. Most notably amongst those, CSL, one of our top weights, had a very good month, as did Chorus, the New Zealand broadband company, and Abacus Property Trust. As we look forward, it's hard not to see a lot of risks now. Obviously, people could say, oh, well, you can always see risks. You don't want to just be a Cassandra, always thinking of what could go wrong, but we are cognizant of the tough environment that probably lies ahead for corporates as consumers face the quadruple whammy of cost of living increases, higher mortgage rates, particularly if they've got fixed rate loans that are going to need refinancing, higher utilities bills, and possibly housing prices falling with the higher mortgage rates that hurts confidence a bit. So consumer spending will be a bit weaker. Companies are dealing with cost pressures. So it will tend to be the quality companies that manage that better, deal better with the weaker demand environment and those cost pressures. And those quality companies are what are in our portfolio.